let's shuffle on to another company making excuses, Steve. This was Vistry, and it's their kind of mid-year check-in. And essentially, if you want a sort of a headline, it's profits down for the reasons we sort of know about, but they're pretty hopeful for the sort of the sort of horizon. So yeah, this was a mixed bag of sort of challenges and strategic realignments, and it's come out with a um, quite a bit of news surrounding the company and the kind of atmosphere that it's trading in as well. So I've tried to try and summarize it all together here. But essentially, the headline item is here that there's a pre-tax profit dip of about 80 million quid, which is about 33% drop compared to 120 odd million in the same period last year. And this compression is largely due to a number of items. There's rising build costs. They think the private housing market is slightly subdued at the moment, and there are these ongoing corrections and cost overruns that they identified last year in the Savon region. Alongside this, though, the revenues have also fallen from about 2 billion to 1.8 billion, and this was a decline driven by fewer home completions, which was 7,792 last year, dropped to 6,800 units this year. Adding to that pressure, there's a metric in the house building industry called sales velocity, and that is basically number of houses sold per outlet per week. So sales outlet essentially, or a sales outlet on a new site. If you've ever been on a new site, it's how many homes that outlet sells per week. And that's dropped from 1.21 to 1.02, which sounds like small movements, but in terms of house sales over a few weeks, it does mean notably less sales. The transition for them into partner-funded units is about 73% of their completions now, so they're still moving over to this strategic shift in focus that they did when they changed from Bovis to Vistry. So yes, this pivot, it's been a sharp pivot towards capital-light partnerships model. Essentially, this means they're just collaborating with housing associations and build-to-rent providers and people of that ilk. Essentially, this hedges the volatility of the open market, meaning that you're not really exposed to having to sell these homes, the whims of how the economy is doing at that specific time. But on the flip side of that, you do get fixed price risk, which means that they can't really go back to the well. So if prices go up significantly, but inside the levels of the contract scope, they can't go back and say, look, if we're going to finish these houses for you, you need to give us an extra 50 million. That just can't happen. And that kind of highlights how big that 165 million cost overrun was last year for them. But on the flip side of that, Steve, that order book looks fantastic at the moment. There's about 4.3 billion in it at the moment in the first half. That's strong partner relations. The land acquisitions were reduced. So yeah, it depends how you feel about that strategy, I would say. So you're basically trading a flatter market cycle for fixed price contracts. So if you think that's a better way of smoothing out the volatility, and Vistry do, then perhaps this is an interesting one for you. So I think crucially for Vistry going forward, it's the Affordable Homes Programme. They're banking on substantial government investments in affordable housing, and they think this is going to sort of help them with the delays in their sort of private market improvements, which they've not seen improving at the rate that they thought they would. They mentioned strong tailwinds from a 2 billion top-up pledge made by Labour in March, which is getting added to the 39 billion affordable homes programme stretching over the next decade. So about 4-ish billion of affordable homes are going to be built per year for the next decade. And they've indicated that they're seeing impactful early contracts coming from it as well. A surge in partner-funded deals are expected in the second half of 2025. And yes, they were keen to highlight that the public sector momentum is kind of pivotal to them hitting these full year targets. But they've actually remained cautiously optimistic about this sustained funding. and that is to give full year profit guidance of about 264 million, Steve. Which, when you've only done 80, you've essentially got to do double that in the second half of the year. RBC released a note shortly after it that said needs a big second half, which is a footballing term, that, Steve. But it is really true. They're 4-1 down and they need 5 goals in the second half. So yes, it's there. It could happen. The government funding is there. If they can spice up the partner demand a little bit, be vigilant in their building cost control, and keep abreast of this low single digit inflation that they're expecting, any kind of improvement in broader sales markets or easing mortgage conditions or better availability would be a real tailwind for them. I don't think interest rate relief is as near as we probably expected it to be, Steve. I think we probably expected to be a little bit lower now, but Vistry's doing okay at the moment. Net debt for them is 295 million, down from 322 million, and they are buying back at the moment. They've done about 57 million in share buybacks on this ongoing program. We also had an update from the CMA, Steve, which I don't know if you saw. This was one of the reasons you were slightly worried about home builders. Essentially, the 7 largest UK house builders have collectively agreed to contribute around 100 million to fund affordable housing. This is because the CMA is currently probing them into data sharing practices. So essentially what they're being accused of doing is kind of sharing specific data about affordable homes and pricing and things like that. Not naughty things that you shouldn't really be sharing between each other. It looks like Vistry's share of this settlement is going to be about 12.8 million quid. And off the back of this, they've also promised the CMA enhanced compliance standards, ending all data sharing on sales, incentives, and viewings between all other house builders. And they were keen to point out that no other admissions of wrongdoing were made. And this is a voluntary settlement to avoid what would be costly litigation, Steve. And I would expect this to go through because I think it is a relatively generous offer, really. So, yeah, in summary, I think the first half was a mixed bag, I would call it. And it's funny, really, because you was relatively confident about this one, Steve, and not so confident about Celebros, and it actually ended up the other way around. But the market thought this was a mixed bag as well. It was up 6% on the news and then finished the day down a couple of percent. But I would say foundations, it's cheesy, but the foundations are being laid here. I think it's heavily reliant on this affordable housing sector, which I think is coming. I think these contracts, government contracts in H2, if they can materialise and Vistry can manage its build cost inflation, which it's laser focused on at the moment, I think it should have a fairly decent second half. Now, whether it can hit that upper number, that's a different story. But they're relatively confident, Steve, and we've gone through a period where management have been pretty bad, and they've not done the best job. It would be nice to come out of the other side and just place a little bit more faith in them. Did you spot anything in there, Steve, that I didn't?
Only a very tiny thing, but I missed plenty that you did spot. Let's start with the thing that you point out that I've been going on about for ages, which is the CMA investigation. It's been the thing that's been putting me off house builders pretty much across the board, actually. Other things in specific cases, but in general, I've been saying I'm not touching this while there's an ongoing investigation into these things because see Lloyd's Banking Group. And that's been my general principle, and I've been very devoutly sticking to it. And I thought directly this goes away if one or two things happens, right, once this resolves. One is they go through the floor because they get clobbered, and I don't want to own the stock then. Or this goes away quietly and the stocks are going to go up a lot because I think quite a few of these house builders look quite cheap to me if you think nothing is coming out of this. And now we have some clarity on this, and it's 13 million in the case of Vistry, 12.8, but call it 13 for the moment, million in the case of Vistry to make that go away. If I were in your shoes, which is to say a Vistry shareholder at the moment also, and a Vistry shareholder at the time that this came out, I think I'd have taken that. Make of that what you will, but I would have been happy with 13 million and get this out of the way in terms of uncertainty. That being said, the stock has not really run away. in any meaningful fashion. I was looking at this at around 600. Google's currently telling me it's 608. Motley Fool was telling me it was last seen at 602. That is all within striking range of where I said I would be interested in this if the CMA thing would kindly bugger off, basically. Or if it came through the other side of it unscathed. I was going to say, I think it's a steal there. Like you, I thought this was a set of relatively uninspiring numbers, but we kind of know why. There are sort of two main reasons. One is those cost issues in the south that they said are going to run through this year's results and to some extent next year's results, but not as great an extent next year's results. And the other is some kind of weakness in the market a bit more generally in terms of higher cost inflation and some slightly weak demand. Okay, that's housing stuff for you, those things. Those are genuine issues. They do weigh on your revenues and profits and so on. The first set of things, which we talked about as south cost overall, they're not housing issues, they're Vistry issues, but they were pretty well known about. And I didn't really see, if you just look at them and you don't know about their south issues, these look like a horrible set of results because nearly everything is down. The one bright point that you pointed out to, which was a 4.3 billion order book, I think that was 5.1 billion last year because I went to go and see how much that had moved. So I didn't necessarily view that as super positive here. I thought that's another number that's lower than it was last time when I'd rather it was higher. However, this to me looks like it might be kind of setting itself up for a sort of big perfect storm thing. And I know it's a lazy comparison for UK stocks, but think about Rolls-Royce for the moment, where they went from everything going wrong to everything going right all of a sudden. Or if you prefer a different example, Netflix. I'm not saying we're in line for sort of 100 and something percent gains in either in this case, but at the moment, their kind of numbers look like they are being hit. They are being hit by cost issues in the south and a weak trading environment. Well, give it 2 years. Cost issues in the south roll off, or should roll off. Environment might improve here, but you're expecting somewhere in the region of 39 billion in government stimulus now blowing the other way. So what you have is, instead of going into a headwind, which is your own cost issues here, and let's be clear, that's no one's fault but theirs, to actually trading in quite a nice tailwindy thing. If you want another example of these things, see the banks, which went from a kind of low interest rate to a high interest rate, and all of a sudden, not all of a sudden, but gradually with some improvements of its own, NatWest is up 100%. It would not surprise me at all to see Vistry, which is currently under pressure, significant amounts of its own making, to reiterate that point, suddenly become a lot more interesting as things start moving in the right direction here, boosted by a big drive for affordable housing. I like this business model. We've talked about this before. So nothing in this I thought was terrific. And it is all slightly kind of optimistic future view here. And if we're thinking dark clouds you can see through, maybe that's the right kind of thing. But you do have to sort of believe the management a little bit when they tell you stimulus coming, and we're going to be really well positioned to benefit from it. And it makes a lot of sense to me, and I do believe them on this. But there is, as far as I can tell, nearly zero sign of that in the current numbers to help you along here. It's one where you have to think things are going to turn around quite quickly, but we have seen things turn around quite dramatically in UK stocks in the last 5 years or so. In the time we've been doing this show, it has been nothing if not interesting watching which stocks have gone up and why they've gone up, and what look like fairly steady, bumpy along companies, which they are, given the right kind of boost behind them, especially if they're coming out of a tough situation and into a much easier one. Suddenly things look an awful lot nicer for them, Steve. I think Vistry and maybe the house builders more generally, but like you, I quite like Vistry here, especially if it stays somewhere near 600. I'm going to have to take another serious look at this, but I'm so overrun with UK stocks at the moment, I don't really know what to do.
So yeah, that was going to be my next question to you, Steve. Has that changed your thoughts on it? Because this was basically the big hurdle that you wanted to get out of the way. So I think it's in a. So we call it stimulus, but I would like to say double stimulus as well, because I think the effective interest rates coming down and the monetary stimulus is a double stimulus for Vistry Group. And I mean, people probably look at it on the face of it and see, look, it's trading at about 28 times earnings at the moment on a sort of trailing 12 months kind of thing, and that would look pretty expensive, like it's we're maybe a little bit overvalued. But the truth of the matter is, it's just depressed earnings because of some problems that they've had in the business, which they'll go away pretty quickly, and in the next year or so, we should see rosier figures. Now, if it all clicks into place for Vistry, they'll look very undervalued very quickly, probably among the most undervalued of the of the house builders. But it is goes, have to say, the reason it fell from sort of 15 quidish a share to £6 a share were entirely justified. These were big oversights, big issues at Vistry that needed correcting, and a big loss of faith in management. But they have the opportunity to turn it around now, Steve, and the wind is definitely behind them. And I am very interested to see where it goes. Where we're sitting now, I am up 0.5%. So still very much in my kind of buying wheelhouse, and probably will be for quite some time, Steve.
It's not so long ago they were talking about medium-term returns of about £1 billion in distributions to shareholders. This was around the time they started falling quite quickly, and that got shelved for the time being. But market cap is currently about 3, and if they're going to return 1 in anything like a kind of orderly fashion, that's your return taken care of for the near future. So be interesting to see when they kind of get back round to that, and I guess could
Market
potentially be
cap's only
higher.
2
Is
at the
market cap
moment.
2 now? Sorry,
Yeah,
my
2
fault.
billion.
Okay, then in that case, call it 50 rather than 33. And I feel like that's delayed possibly by a couple of years, but is 50% worth waiting a couple of years for, especially if they're kind of making their way through the other side now? Don't know. Maybe. Might be worth starting to
The
make a move
market
here.
won't. Yeah, the market won't wait. The minute it gets a whiff of those improvements, it'll be projecting those onwards. And yeah, I feel like I've got quite a lot at the moment, but I could buy quite a lot more.
I feel like I've got none at the moment, but that makes it look quite different to me. Time for some thinking, I think, on that one. But I am in the unfortunate situation of probably selling to buy, so not sure there's anything I want to let go of, but do want to try and buy this. Might be cutting bits off of places. We'll see. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.